Refinancing your mortgage could mean banking on a lower interest rate, but is it worth it? Here are 4 essential questions to ask before making a decision. Today's low interest rates may give some homeowners who bought their homes further back some financial FOMO. And while it is true that refinancing a mortgage to a lower rate can be helpful in reducing your monthly loan payments, the math doesn't always make sense. Before you fill out a refi application, ask yourself these 4 essential questions. The first is, what will be my monthly savings from the refinance? Now, let's say that you find out you can refinance to a lower rate, which pockets you $100 a month. That's a savings of $1,200 a year. Or is it? Let's hold on to this number and move on to see if this is going to pay off in the long run. Now, the next question to ask is, what are the costs to refinancing to this new mortgage? Find out from the lender what the approximate closing costs may be to refinance. Now, they tend to be anywhere from 2 to 5 or 6% of the loan amount. But the refinancing costs will depend on a few things, including the size of your loan, your credit score, your available home equity, as well as the type of mortgage that you're seeking. For example, whether you want a firm or a 30-year term. Now, some smart ways to lower your refi costs are, first, raising your credit score. This may take a little bit of time, but a higher score can often help you access the best refi deals. And the number one way to raise your score is by paying your bills on time and knocking down your credit card debt. Another way to lower your refi costs is to talk to various banks. The best deal may not be with your existing bank. You can always refi with a different financial institution if it means saving more money. And last, remember that you can negotiate your refi costs. You can just ask, especially if the lender knows you're open to taking your business elsewhere. You could score some of your fees getting knocked down or being waived altogether. If you like what you're watching, be sure to hit that subscribe button so you don't miss out on more financial advice. Now, once you know your cost to refi, in other words, what you'll pay in fees and in closing costs, compare that with how much the refinance would actually save you over time. In this example, let's say that the refi costs are $7,500 after you've tried to negotiate and all the things. Now, this means that the break-even point where the accumulated savings from the refi adds up to the cost of the refinance is at 6 years and 3 months. After that, the refi would begin to actually save you money. Now, let's hold on to this fact and move on to the next question, which is this: how much longer do I plan to live in the house? Remember that you're only going to break even on that refi at 6 years and 3 months. So if you plan to move before that date, the refi would not have been financially worth it. Now, most people can stop at question 3 and they have their answer. They know whether or not a refi is truly worth it. But some others might want to answer this final 4th question, which is this: how many years do I have left before I am debt-free on my mortgage? This is important because a refi essentially restarts the clock on the mortgage if you're going from an existing 30-year to a new 30-year mortgage. So let's say you have just 5 years left on that 30-year mortgage. You're pretty close to the finish line. You've been paying into this mortgage for 25 years. Now you're going to start the clock over, paying into a new 30-year mortgage. Even though it's a cheaper loan on a monthly basis, this could mean many more extra loan payments in your future and a much more expensive move. So rather than becoming debt-free in 5 years, you end up shelling out more money over the long run, making the refi far from worth it. Now, if you like this video and you want more financial advice, be sure to hit that subscribe button. For CNET, I'm Farnoosh Torabi.